Hello, this is Warm Insight. Today, we're going to talk about the hidden fault lines in the global economy and the silent repricing of the world's wealth. Leaving a like and subscribing is a huge help to us. Did you know that during the 2008 financial crisis, the assets that nearly destroyed the global banking system were not publicly traded stocks, but opaque private financial instruments that everyone simply assumed were perfectly safe? We might be making the exact same psychological mistake right now. As we survey the economic landscape today, a gentle unease ripples beneath the surface of the daily market gyrations. We are seeing seasoned voices from the private capital world openly questioning valuations, especially in the technology sector, while geopolitical tensions continue to stir the energy markets, subtly shifting our expectations for interest rates. It is a moment that reminds us to look beyond the screaming daily headlines and appreciate the deeper, invisible forces at play. Let us start with the whisper of repricing in private markets. For years, many of us have watched private equity and private credit valuations, particularly in the software and technology space, grow with a vigor that often seemed completely disconnected from public market realities. During the era of 0% interest rates, money was essentially free. Investors were desperate for yield, so they poured trillions of dollars into private markets. Because private companies do not trade on a public stock exchange, their value is not determined second by the collective wisdom of millions of buyers and sellers. Instead, their value is calculated by complex financial models. This is what insiders call mark-to-model rather than mark-to-market. It creates a powerful illusion of stability. If you do not check the price of your house every single day, you never see its value fluctuate, but that does not mean the underlying value has not changed. Today we hear John Zito from Apollo, a true veteran of this arena, candidly state that all the marks are wrong. This is not just a casual remark. It is a profound signal from someone who intimately knows the plumbing of the global financial system. Apollo manages hundreds of billions of dollars. When a leader at a firm of that magnitude says the valuations are artificially inflated, the entire financial world needs to pay attention. J.P. Morgan Chase, the largest bank in the United States, is also reining in its lending to private credit. They are showing a pragmatic foresight to get ahead of potential turbulence. Banks make money by lending, so when a massive bank decides to step back and leave money on the table, it means their internal risk models are flashing warning signs. We also recently saw Robinhood's venture fund, which was designed to give everyday retail investors a slice of the lucrative private pie, plunge on its debut. Retail investors often get access to these exclusive asset classes right at the peak of a market cycle, historically acting as exit liquidity for the institutional giants. What does this truly mean for you and me? It speaks to a fundamental behavioral pattern. It highlights the deeply ingrained human tendency to extrapolate recent success indefinitely and to believe that this time is different. In frothy, high-liquidity markets, illiquid assets often hold on to phantom value for far longer than their public counterparts, simply because they are not forced to confront reality on a daily basis. This creates a psychological comfort zone that can lull participants into a false sense of security. Historically, whether it was the dot-com bubble of the late 1990s or the subprime mortgage crisis of 2008, the areas of the market with the least transparency and the slowest repricing mechanisms were almost always where the most significant and toxic imbalances festered. This is not necessarily a crash warning. Rather, it is a vital and healthy recalibration. It is a collective moment of sober reflection on what true value entails. When the easy money retreats, we are seeing the market's nervous system finally catching up, demanding a return to fundamental economic realities. Zombie companies that only survived because they could constantly borrow cheap money are finally facing the consequences of higher capital costs. Now let us transition to the energy crucible and how it is violently shifting interest rate expectations. The shadow of geopolitical tension, particularly the ongoing situation in the Middle East, and its direct impact on the Strait of Hormuz, continues to loom large over the global economy. Approximately 20% of the world's daily oil consumption passes through this narrow, 21-mile-wide choke point. Today's most critical new information is not just about oil prices, threatening to surge past $100 a barrel, a scenario that consistently tests our collective economic resilience. The real story is how these elevated energy costs are directly impacting The Federal Reserve's monetary playbook. Market hopes for swift and aggressive interest rate cuts, which were previously a very comfortable assumption for Wall Street, are now rapidly fading. This changes our previous assumption from cuts are coming soon to higher for longer. Rates are a distinct possibility, if not an absolute probability. From a behavioral psychology standpoint, the fear of inflation, particularly cost-push inflation driven by skyrocketing energy prices, triggers a primal sense of scarcity and economic vulnerability. Cost-push inflation happens when the basic building blocks of the economy, like oil and transportation, become more expensive. This forces companies to raise prices just to survive. It acts like a massive regressive tax on the consumer. If you have to spend an extra $100 a month just to fill up your gas tank to get to work, that is $100. You cannot spend on new clothes, dining out, or software subscriptions. This can lead consumers to drastically pull back their spending, even if other economic indicators like employment are currently strong. Historically, every major oil shock from the 1970s OPEC embargo to the early 2000s price spikes has severely tested the market's resolve. In several historical instances, these energy spikes directly precipitated severe economic recessions and vicious bear markets. These are not just abstract economic events. They are profound philosophical tests of our global interconnectedness and our heavy dependence on a stable, cheap energy supply. It reminds us that endless prosperity is not a given. It is a highly delicate balance, susceptible to immense forces far beyond our immediate control. The market is now keenly aware that the benefits of any government, stimulus, or economic growth could be quickly eroded by the relentless grind of higher fuel costs on household budgets and corporate bottom lines demanding a massive pivot in investment strategy. The Federal Reserve is trapped. They can print trillions of dollars, but they cannot print a single barrel of oil. If inflation stays high because of energy, they cannot lower interest rates to rescue a slowing economy. Meanwhile, across the Pacific Ocean, China is navigating its own incredibly intricate path. While they have recently set a more tempered GDP growth target, reflecting a pragmatic realism amidst intense global headwinds, we are seeing incredibly strong internal momentum. Holiday spending and export demand are driving their economy. But what truly captures my attention is the open claw phenomenon. China's massive technology, firms are not just casually embracing artificial intelligence. They are feasting on it. They are driving an aggressive demand for lower-cost indigenous AI models. Their usage of open source AI systems has reportedly surpassed the United States in several key metrics, showcasing a massive coordinated push for absolute technological self-sufficiency. Furthermore, Beijing is loudly talking up its oil sufficiency and domestic production capabilities, even as they prepare for a potential diplomatic meeting between Donald Trump and Xi Jinping. This is a complex dance of high stakes, diplomacy, and strategic economic independence. This reveals a profound cultural and historical pattern. It shows a long-term strategic vision, combined with a ruthless willingness to adapt, where Western economies often obsess over immediate quarterly returns and keeping shareholders happy for the next 3 months. China's approach frequently reflects a much longer game. They are identifying critical technologies like artificial intelligence and green energy, not just as profit centers, but as existential strategic imperatives for future national security. From a behavioral perspective, this collective national ambition, coupled with an absolutely vast domestic consumer market, creates a powerful feedback loop for rapid innovation. It is not just about chasing standard economic growth anymore. It is about completely reshaping their industrial landscape and systematically reducing external dependencies, particularly when it comes to imported energy and foreign semiconductor technology. While their economy undoubtedly benefits if global oil prices surge, as Goldman Sachs suggests, their broader structural strategy is about building an impenetrable fortress of resilience, completely, irrespective of global energy market whims. This unique blend of tempered growth expectations, aggressive technological ambition, and energy. Prudence offers a deeply nuanced picture of an economy that is thoughtfully managing its long-term trajectory in a fracturing world. In times like these, when private valuations are being sharply questioned, and geopolitical flashpoints are completely shifting global interest rate expectations, it is entirely natural to feel a tremor of uncertainty and fear. My advice to you, honed over decades of watching market cycles, boom and bust, is to relentlessly lean into the core fundamentals of investing. Focus on quality, diversification, and above all, emotional discipline. Consider deeply how your portfolio is positioned right now, not just for aggressive growth, but for unshakable resilience. Look at dividend-paying stocks, for example. Many of these reliable companies are showing incredibly compelling earnings growth relative to their highly priced, speculative tech counterparts. They offer a tangible, reliable income stream and serve as a historical ballast against extreme market volatility. Remember that true financial freedom is not just about accumulating the biggest pile of wealth. It is about cultivating a deep peace of mind that allows you to confidently navigate the market's inevitable ebbs and flows with wisdom and infinite patience. Do not obsess over the daily fluctuations of the stock ticker. Focus only on what you can actually control. Control your long-term strategy. Control your personal savings rate. And strictly control your emotional reaction to the deafening media noise. Walking through the city today, I felt a familiar heavy tension in the air. It was that slight collective holding of breath as we all wait to see if the market's recent, arrogant confidence will hold, or if a much deeper, more painful correction is truly brewing on the horizon. It heavily reminds me of those incredibly calm, completely silent moments just before a massive storm makes landfall. In those moments, the absolute best thing you can do is simply secure your financial anchors, prepare your shelter, and look patiently for the steady, unmoving horizon. What is your personal anchor in times of financial uncertainty, and how are you preparing for a potential market shift? Let me know down in the comments below.